The effectiveness of corporate governance depends upon a set of fundamental principles that guide organizational leadership, decision-making, accountability, and ethical behavior. These governance concepts establish the standards by which boards of directors, executive management, and other organizational leaders exercise authority and discharge their responsibilities to shareholders and wider stakeholders. Within the program, governance is founded upon a series of interrelated concepts including probity, transparency, independence, fairness, integrity, reputation, responsibility, judgment, skepticism, accountability, and innovation. Together, these principles promote ethical leadership, strengthen organizational legitimacy, reduce agency conflicts, and support sustainable value creation through responsible governance practices. The principle of probity, often described as honesty and ethical conduct, forms the moral foundation of corporate governance. Probity requires directors and senior executives to act truthfully, avoid deception, and demonstrate integrity in all business activities. Organizations characterized by a culture of honesty are more likely to foster stakeholder confidence, maintain regulatory compliance, and reduce the risk of fraud or unethical behavior. Ethical leadership from the board establishes the tone from the top, influencing organizational culture and encouraging employees to act consistently with corporate values. Consequently, probity supports both effective governance and sustainable organizational reputation by embedding ethical standards throughout decision-making processes. Closely associated with probity is integrity, which refers to unwavering adherence to strong moral and ethical principles even when commercial pressures create incentives for unethical conduct. Integrity requires directors to make decisions based upon fairness, objectivity, and professional responsibility rather than personal gain or short-term financial advantage. Governance systems supported by integrity strengthen stakeholder confidence because decisions are perceived as consistent, principled, and trustworthy. In increasingly complex business environments, organizational integrity contributes significantly to long-term resilience by protecting reputation and maintaining public confidence during periods of uncertainty or strategic change. Another essential governance principle is transparency, which requires organizations to maintain open communication, provide reliable information, and explain significant decisions clearly to shareholders and stakeholders. Transparent governance reduces information asymmetry between management and investors while strengthening accountability and market confidence. Effective transparency extends beyond statutory financial reporting to include disclosures relating to governance structures, executive remuneration, sustainability performance, strategic risks, and long-term corporate objectives. Modern governance frameworks increasingly emphasize integrated reporting and stakeholder communication as mechanisms for demonstrating organizational accountability and responsible stewardship of corporate resources. The governance framework highlights transparency through open relations with shareholders and clear decision-making processes. Independence represents another cornerstone of effective governance, particularly regarding board composition and oversight functions. Independent directors are expected to exercise objective judgment free from conflicts of interest or undue managerial influence. Independence enables non-executive directors to challenge executive decisions, monitor performance critically, and protect shareholder interests through impartial oversight. Independent board committees responsible for audit, remuneration, and nominations further strengthen governance by ensuring that key decisions receive objective scrutiny rather than managerial self-interest. Maintaining independence therefore reduces agency problems and enhances confidence in board decision-making. The concept of fairness requires organizations to treat all stakeholders equitably while balancing competing interests responsibly. Fairness extends beyond shareholder rights to include employees, customers, suppliers, creditors, regulators, communities, and future generations whose interests may be affected by corporate decisions. Governance frameworks encourage organizations to avoid discrimination, abuse of power, or preferential treatment while ensuring that strategic decisions reflect principles of justice and ethical responsibility. Fair governance therefore strengthens stakeholder relationships and contributes to long-term organizational legitimacy and social acceptance. Governance also depends upon responsibility and accountability, which ensure that directors accept ownership of their decisions and remain answerable for organizational performance. Responsibility requires clear allocation of authority, defined governance roles, and effective oversight mechanisms that prevent ambiguity regarding decision-making authority. Accountability complements responsibility by requiring boards and management to provide complete information, explain their actions, and justify strategic decisions to stakeholders. Together, these principles strengthen internal control, improve risk management, and enhance confidence in organizational leadership through transparent reporting and effective governance structures. The program further emphasizes professional judgment and skepticism as essential governance competencies. Judgment enables directors and senior leaders to evaluate complex situations, balance conflicting stakeholder interests, and make informed strategic decisions under conditions of uncertainty. Professional skepticism requires a questioning mindset that critically assesses evidence, challenges assumptions, and scrutinizes management representations before accepting conclusions. Independent non-executive directors, auditors, and board committees rely upon skepticism to identify weaknesses in governance, internal control, and risk management, thereby reducing the likelihood of strategic failure or unethical conduct. Innovation in governance reporting is also increasingly encouraged to improve communication of organizational value creation rather than relying solely on rigid compliance-based disclosures.